morning. It's Friday, the 7th of August, and thank you for joining us on Ridge Radio's Business Show for all business owners wanting to start or grow their business. And today's show is hosted by myself, Chantal.
And me, Matthew.
And today's show is a little different. Today's topic of the day is property tax, basically. So we're going to be looking at various property taxes and various capital gains tax, income tax, stamp duty, being a landlord, and various other things as well.
Everything that landlords need to know about finance.
Exactly. So if you have any questions, the show's going to be done a bit differently today, isn't it, Matthew?
Yes, well, we're still no guests in the studio, so today I'm going to be the guest firing the questions at Chantal. We're going to make use of her property tax expertise, and we're going to see what we can drill down into. And if you have any questions about being a landlord or want to know anything about tax, then why not use the opportunity to send your questions to us?
Yeah, so any questions that you might have, we're available to answer your questions. Please do email them in, studio@ridgeradio.co.uk.
We're also on Twitter @RidgeRadioUK, and we have a Facebook page, The Business Show on Ridge Radio.
Yes. So, Matthew, there's been a lot in the news, all about landlords, stamp duty, various things. And I suppose as Champ consultants with accountants, we've had a lot of clients who have contacted us over various times, really, with very regular questions, which we thought we'll do a good show for you today, enabling you to be able to find out a bit of this information, really.
Well, it's not just this year with the COVID situation and things that the government have done recently, but over the last few years, and certainly the last few budgets, there's been a tax, if you like, on landlords, and the government trying to squeeze a little bit of extra tax out of landlords. So we can talk all about those changes that have taken a little while to come into effect, and they're really taking full effect now. And that will come up in today's questions.
Yeah. So, Matthew, do you want to fire away with the first question?
Okay, well, where shall I start? Let's start with a nice, easy one for you, Chantal. This is for someone who wants to earn more money for whatever reason, but obviously a lot of people would like extra money right now, and maybe you want to rent a room in your house out to someone. And this is not for a family member, this is for just anyone. So are you allowed to do this? And do you have to pay tax on that income?
So this is known in the tax world as the rent-a-room scheme, effectively. So this would be for maybe somebody who's got a spare room in their house that want to rent it out to a tenant and generate an additional source of income. So you would rent out one bedroom in your house, let's say, and they would be able to use the rest of the house with you.
Within reason.
Well, yes, obviously, not your bedroom, bathroom while you're in it and stuff. But, yeah, so they would be able to rent a room in your house. And this is called the rent-a-room scheme. In the past, the amount of money that you were able to receive was quite low, but a couple of years ago, I believe it was now, the rent-a-room threshold went up to £7,500 a year. So that means that you're allowed to earn £7,500 a year, and that would be tax-free income to you, for you for renting out a furnished room in part of your house. So that works out, I haven't got a calculator.
That's £625 a month.
Right, okay, I wasn't going to work it out a month, but I didn't have it there.
But if you lived in some palatial mansion somewhere and you decide to rent out a room and you charged £1,000 a month, but the person was only there for, say, 6 months, and then the other 6 months of the year you had no one, that's fine, isn't it? Because it's under the £7,500 limit.
Yes, exactly. So you're allowed to earn up to £7,500 a year. However, what you've got to be aware of is that if you live in the house with your partner, so say there's you and your partner living in one bedroom of the house and you're renting out another bedroom of the house, that £7,500 is shared between you and your partner. So it doesn't mean that you get 7.5 and your partner gets 7.5.
It's per property, really.
It's per property that you actually physically live in. So you have to be living in the property as well.
Well, what about if you had, say, a log cabin in the garden and you rented that out? Does that count as a rent-a-room?
Yes, it does, because it's all part of your property.
Okay.
It all has to be part of the same sort of property. I suppose it's different if it's a self-contained annex. That would be slightly different.
Because they're not interacting in your house.
Because they're not using the rest of your... The whole point of a separate annex is that it is self-contained, so it would be like a separate flat. But the actual house that you're living in would then be part of the rent-a-room.
So if you had an annex or a log cabin at the end of the garden you were using on Airbnb, that would be normal rental income.
That's right.
That wouldn't be rent-a-room.
No, because that would be a self-contained unit.
Okay.
So I hope that's answered that question.
It has. And then for someone who has just become a landlord, maybe they've inherited a property or they've gone and bought their second property, if you like, the one that they're not living in, and they decide to rent it out. They know they've got to pay tax on the rent that they receive, but are you allowed, like in a normal business, to offset expenses against that rental income?
So, yeah, you can.
And in that case, what could you claim?
So, yes, you are able to offset some expenses against it. The first thing to do that we have to be aware of is that if you become a landlord for the first time, you have to register with HMRC as being a landlord, unless you already do self-assessment tax returns for other reasons. Perhaps you've got self-employment income and then you've just got this additional rental income. But if you don't normally do self-assessment tax returns and your rental income is your first source, then you do have to register with HMRC as the need to do a tax return. Your requirement to register as a landlord with HMRC, the deadline is the 5th of October in the year after the end of the tax year in which you started renting the property.
That seems quite generous. It's a long time. Yeah,
so let's work out. So say you started renting the property in March 2020 or January 2020. The tax year ends on the 5th of April 2020. So you would need to register by the 5th of October 2020. Okay. But if you started renting in, say, June or July 2020, you would need to register by the 5th of October 2021.
Okay.
So depending on where in the tax year.
Go to the end of the tax year and then on to the next October. You can register earlier than that.
Yeah, you can, but that's a deadline.
And it won't change, the number of tax returns you have to do or when your deadline.
No.
The deadline is still the January after that October.
Yeah, and I always say actually it's better to register early so that you don't forget. Then it's done, isn't it, really?
The earlier you file your tax return, the longer you've got to plan for that tax bill.
Exactly. So the expenses that you are able to claim are general maintenance and repairs to the property, but not improvements in the property, such as something that would enhance the value of it. So if it's a like-to-like improvement, then that's fine.
So if you replace a broken window, that would be all right.
That's fine. But if you go from single glazing to double glazing, that's an enhancement, and therefore that's not allowable.
So what do you do with that cost? Can you do anything with that?
So that would be capitalised. So you can treat that as a capital item, and then when you come to sell the property, that will be treated as part of your cost and therefore reduce your capital gains tax.
It's part of the cost of buying the building when you're working out how much profit you made when you sell.
Yes, because obviously it's an improvement over time. Another one would be sometimes the landlord might have to pay for water rates, council tax, gas, electricity. A lot of the times the tenant pays for lots of these products, but there are times that the landlord has to pay for them, especially maybe in empty periods, and therefore they would be deductible as well. You've got insurance. It's always the responsibility of a landlord to insure the building of the property. The contents are normally down to the tenant to insure, but this is obviously something that you have to look at your contract that you're drawing up with your tenant. These buildings insurance, public liability insurance, if you should pay for contents insurance, landlord's insurance, all those ones are tax deductible against your rental income.
Sometimes the insurance, if it's especially in a block of flats, you own a flat in a block, will be paid via the service charges, the building's insurance.
Yes.
So would those service charges, because there might be cleaning of the hallways and the ground maintenance and stuff, all of that, those service charges, you can claim those?
Yeah, so if you've got a flat, you would have service charges, ground rent as well. Those would be tax deductible as well. You've also got potentially you've got in change of tenants, you might have a cleaner that goes in and cleans the property. You might have a gardener. If you've got a house with a garden, you might pay for it to be well maintained rather than relying on the tenant. So that will be tax deductible. If you've got a letting agent involved, then that would be tax deductible as well.
Because they charge commission on their rents.
Exactly. So the rental income that they would receive and the management of all of that would be tax deductible. And sometimes if you use a letting agent, they send out their guys for the plumbing or various repairs and stuff. Those would be tax deductible as well.
What about statutory things? So, for example, some councils, I know Croydon Council do, you have to register to be a landlord and they do an inspection and they charge you for that. Or if you need, say, a gas safety certificate for the boiler, all those kind of expenses, are they all tax deductible?
Yes, so they're all tax deductible. So you have, obviously, Croydon do it. I know that Newham Council do it, and I think that...
I think a lot of the London councils do this at the moment.
Yes, exactly. They, all those ones you are entitled to claim that as a cost as well. If you use an accountant, which naturally I would recommend that you do, then the accountant fee is tax deductible as well. If you've got costs such as phone calls, if you're looking for tenants and stuff like that, or if you're looking for a good managing agent, if you're having to buy stationery, if you're having to advertise it yourself, all those costs as well would be deductible. If you have to go and visit the property, then obviously you've got vehicle costs, so you would normally claim mileage on those.
So going to visit your own property, because maybe the tenant's left and you've got to go and inspect it,
yes,
etc., you can claim the cost of your travel.
At 45p a
month. 45p a month, okay.
Yeah. And then obviously you might have to change a bed, or the bed might break, or the washing machine might break. You might have to put a new washing machine in, or... I don't know, maybe there wasn't a washing machine and the tenant now asks, or there was a big fridge freezer and you need to put a freezer in, all sorts of those sort of things. They're tax deductible as well. So
basically all these costs that we've been talking about, you can take them off of the rental income before you work out how much tax you've got to pay. Exactly.
So they would be your expenses that you would be able to deduct off of your rental income.
Okay. Very good.
And then you would pay, that would be your profit, and then you would put that on your income tax, well, your self-assessment, and then you would pay income tax on that at the rate depending on your tax rate.
And the rate depends on what your tax rate is, depending on what other income you've got. So if you're in a job or you're self-employed, you'll already be paying tax probably, whereas if you've got no other job and you're only a landlord, the first 12,500 is tax-free.
Yes, exactly.
Yeah. Okay. And if some of those costs include VAT, can you claim the VAT back?
No. Unfortunately, as a residential landlord, you're not entitled to claim back any of the VAT. You're not allowed to be VAT registered and claim back the VAT on your...
But equally, you won't charge VAT on your...
Correct.
On your rent.
Correct. And that's why you're allowed to deduct the entire cost against.
But you said residential property, so if you're a commercial landlord and you own shops or something, that might be different.
Yes, these are basically for residential landlords. If you are commercial landlords, it's a different situation. The VAT is slightly different. You might have to opt to tax the building first before you're able to claim back the VAT
so
on it.
It's not straight cut. You have to get advice from your accountant.
Yeah. If you're going to go down a commercial route, or if you're even going to look at developing properties, I would say then obviously speak to somebody who understands property tax. Then they would be able to explain to you what you can and can't do, because rental is very different to developing.
Okay. Now, we haven't talked about, in the expenses, mortgage interest. And I know that's quite a big topic because that's come up in the last few budgets. So a lot of people have heard that the rules on mortgage interest has changed. So some people have got the impression that you can no longer claim mortgage interest as a cost. And it's quite a significant cost, especially if you've borrowed quite heavily against the rental property, if it's not an inheritance. So is it correct that you can't claim mortgage interest anymore?
So the way the mortgage interest is calculated as a tax relief is slightly different than it used to be. It's taken 4 years for the revenue to change the way they calculate this. And this is now, we're now into the change.
Year 4 now, are we?
Yes, we're now into the change, effectively. So it does not mean that you can't get a relief for your mortgage interest. But as we mentioned before, just a minute ago, we had all the rental income and we had all the expenses against it. And we said that you would pay tax on that at your prevailing income tax rate at that high rate. The mortgage interest is not one of those costs that are then deducted from all those expenses. The mortgage interest is then given to you as a tax relief. And the way that's done is that once you've worked out how much tax is actually paid on your rental income, so if you're a 40% taxpayer, you would pay 40% tax on that profit. Then your mortgage interest is calculated as you take the total mortgage interest for that year and you times it by 20%, which is the basic rate tax relief, basic rate tax band. And that is your mortgage interest tax relief, effectively. So if you were to pay, say, £5,000 of mortgage interest, 20% of that would be £1,000. So you would then have £1,000 deducted from your tax bill.
So whether you're a 20% taxpayer or a 40% taxpayer, you can only claim 20% on the mortgage interest?
Yes, and the mortgage interest is calculated after the tax is actually calculated. So it's not deducted. So the mortgage interest doesn't come above with all the expenses. It comes below once you've worked out what the tax bill is.
And what if your rental profit, after you've deducted your expenses from your rental, is less than the mortgage interest? Does that affect it? Then
you only get the mortgage interest up to that tax relief band. So the mortgage interest tax relief can't give you a negative situation.
Right.
So if, say, where we had the £1,000, if your tax bill was only 900, you would only get the 900 relief and the £100 would be lost. You wouldn't get the full advantage of that £1,000.
Okay.
It's very rare that you would have that situation, though. I suppose you would only have that situation if you are not got any other income and therefore you're using your £12,500 personal allowance.
That's very interesting. So now we know what we can claim in terms of expenses against our rental income. So you don't just pay tax on the income itself. So we can have all those expenses. So that's really good.
Yeah.
Champ Consultants is an award-winning independent firm of highly experienced, qualified accountants and tax advisors based in Caterham, providing a fully comprehensive range of accountancy and tax services. If you would like simple but creative answers to your tax problems, call Champ Consultants, your business partner, on 01883 349 300.
And welcome back to the Business Show here on Ridge Radio with me, Matthew, and Chantal. So we are from Champ Consultants, and we're very lucky that we have a chartered tax advisor who is a property tax specialist, and that's Chantal, who's sitting in front of me. So I've been firing a load of questions to her, and before that musical break, we were talking about rental income and what expenses you can offset against it. And we talked about mortgage interest as well and the changes to that. So now I'm going to throw some slightly more detailed questions at Chantal and see if we can dig a little bit further into the realms of property tax for landlords. So, Chantal.
Yes, Matthew.
I've heard that people are putting their properties into a limited company. So, why would they do that? And if they did, could I put my main home into a limited company? Will that help me some way? Will I save on inheritance tax? Or what would that do for me?
Right, okay, so we've got two big topics here. So we've got putting our main home into a limited company and putting our property investments into a limited company. So we're going to look at putting our main home because that's a nice straightforward answer for me. And the answer is never even consider doing this. This is probably the biggest faux pas in history. The main reason for that is that from an inheritance tax point of view, if you own your main home, you also have something called the nil rate residence band. So that gives you another £175,000 a person inheritance tax free if you own your main home and pass it down to your children or stepchildren.
So this is where a husband and wife, when they own their own house, they can pass on to their children their house and their assets up to £1 million tax free, isn't it?
Yes, this is part of that £1 million
right.
thing. Whereas if you didn't actually own your own home because it was put into a limited company, you've now lost that 175.
Wow.
So that's a no-no. In addition to putting properties into limited companies, so what we'll do here is before we look at investment properties, we'll look at holiday homes, effectively. So you might have your main home, which is covered under your inheritance tax, and then you've got your rental properties, and then you've got your in-between, which is maybe a holiday place, a place down in Devon or Cornwall or whatever. So you've got a holiday place that you want to put into a limited company. Now, if you put a holiday place into a limited company, this also is a benefit to you if you go and stay in the property. So if you are to go and stay in the property, you either have to pay the company commercial rent, or you have to pay a benefit in kind on the property. And as well as that, you would have to pay an ATED charge.
ATED? What's ATED?
ATED is a tax which stands for Annual Tax of Enveloped Dwellings. And it's only for properties worth more than £500,000. But £500,000 property in that limited company would cost you about £7,500 in tax a year. So
quite a serious amount.
Yes, and that goes up. So it's not always worth it, and you just need to talk to somebody about that. The biggest one we have is people putting their property investments into a limited company. This has its benefits in that the main benefit for here is our mortgage relief interest, effectively, because as we discussed earlier, our interest is not deductible as an expense against our rental income when we have a normal self-assessment.
You still get some relief on mortgage interest.
Yes, you get the 20% relief. But you've still got to pay the 40% tax if you're a 40 or 45% taxpayer. Okay. So effectively, you could be paying 40% tax and you'd be losing part of that tax. Effectively, you end up paying more.
Yeah.
As a limited company, you would then have that mortgage interest will be tax deductible against your expenses. So it would be a normal expense that a limited company could claim against a rental property. So that is a benefit.
But you only get the tax relief at the prevailing corporation tax rate, which is the lower rate anyway.
Which is at currently 19%. Overall, the calculations of the number, if you do the calculations of the numbers, it actually works out that you are better off in a limited company.
Because you then pay less tax because of the drawing of the money out of the limited company.
And also because of the 40% that you are paying at the higher figure.
Yeah.
The other things that you've got to consider in putting things into a limited company is whether there's a mortgage on the property. If there's a mortgage on the property, you would need to inform the mortgage company, and you would need to have the company have that mortgage rather than you personally, because it's now the company's asset and not your asset. And then you would also have, if you're transferring the property into the limited company, you could potentially have capital gains tax and stamp duty to consider there. But I would probably say that if you've got a portfolio of property investments, it's worth discussing it and giving the numbers to your accountant to crunch the numbers so that they can work out the overall tax position that you would have to pay in order to transfer it to the limited company. Now, the advantage...
Well, you just mentioned stamp duty.
Exactly. So at the moment, the advantage is the stamp duty rate. And as we know, there is a stamp duty holiday. And the stamp duty holiday is valid until the 31st of March 2021. And it's at 0% for the first £500,000. However, companies who purchase properties, and in this case you transferring an asset to a limited company is like the company's purchasing the asset, has to pay a higher rate. So they have to pay an additional rate. Now, if the property is worth less than £500,000, that company would only have to pay 3% on that first £500,000. However, if the property is worth more than £500,000, the company actually has to pay 15% because it doesn't benefit from that holiday.
So it's quite a serious amount if you want to put it into a limited company.
Exactly. But you are still saving on that first 3%.
And do companies, if it's more than one property that you're moving in, do they pay on top of that and then an additional 3% for multiple properties? Or is that only for individuals?
Well, no, because the company is paying the additional rate, which is the extra 3%.
That additional rate is the same thing?
Yes.
Right.
Yes. So the company is paying the additional rate of the 3%.
Okay.
So lots of people, what they might do in this current moment in time is they might have inherited a property in the past few years, and they might want to transfer the inherited property over to a limited company because there'll be no tax to pay because the property hasn't gone up in value, probably potentially very much. It's worth probably less than $500,000 maybe. They can transfer that into a company and only have a 3% stamp duty cost. And then that way they've got it. If they're a 40% taxpayer, they've got it shifted over, and they don't have to worry about mortgages.
And if you're a landlord with a portfolio of flats, they're all going to be maybe hopefully less than $500,000, so you can transfer as many, and they're all at 3%.
Yes, which is the additional rate.
But obviously the disadvantage, you touched on capital gains tax there. If you've bought the flat or inherited the flat recently, you'll be fine. But if you've owned them for a long time, they would have gone up seriously in value.
Yes.
So you're going to have to pay tax on that increase in value, are you?
The capital gains tax, yes. But you need to just discuss all those bits with your accountant because it's a number crunching exercise, and you might find that the numbers actually work out, in which case it's a lot better of a situation to actually do. And it is a number crunching exercise, which your accountants can actually do for you. So, yeah, it's definitely worth considering.
Okay, so we've had a question in. I can't find it. Where has it gone? There it is. So we've had a question come in on our social media, so thank you for that. It says, what happens if you own a property in a company, but you're financing it by borrowing money in your own name? Can you claim the interest on this funding in the company? I mean, that can't be a mortgage, though, can it? Because you can't take a mortgage personally on a property that's owned by someone else.
Exactly. So you can't take a mortgage on a property that you don't actually own.
But if you took out a personal loan.
But if you, example, say what some people might do is if they've got a lot of equity in their own home, they might take out the interest, they might take out a loan from their own home and use that money to then buy a property, which the company would then buy.
So they're effectively lending the money they've borrowed on their own property to the company?
Yeah, so what that situation would be is there you would have a loan between you and the company. The company would be able to pay you back the interest element. From your tax point of view, you would be able to offset the interest you're receiving against the interest that you're paying as a loan interest, and that would be an offset in your book. So you wouldn't be paying personal tax there. The company would be able to get the tax relief there. However, if you've got a repayment mortgage and the company is paying you the whole repayment amount, the capital amount that you're receiving is then treated as income in your book, in your hands. So you might have to pay income tax on the capital amount that you're receiving, but not on the interest amount that you're receiving.
Right. So just be careful and get the right advice about how much the company can pay and just cover the interest element.
Yeah, because if you're a 40% taxpayer, you might have to pay a higher rate there, and then it might be a worse situation.
But the company, if it was matching your repayment mortgage, you could offset some of the loan and reduce the balance of the loan the company owes you.
Exactly.
Yeah, so you just have to do it correctly.
Yeah, so it is possible to be done, but you've just got to make sure that the calculations and the administrations of it all is all done correctly and properly. What you don't want to do is end up trying to save a load of tax and then end up costing yourself a lot more tax because you've just pressed the wrong buttons effectively or transferred too much money out for yourself. But these are very complex areas and very complex situations. So please note that whatever I say on air is as it is now. Situations can change massively over time, over week to weeks or even
Well, we've seen the speed
months.
with which government have brought out legislation in the last few weeks.
Exactly. So we've just got to be aware of things. And also, I would always say, please seek independent professional advice before doing this. And I'll explain about an accountant later on. I'll write a note here to explain about an accountant and their qualifications.
Okay. And here's another question. So for someone who does own a property and they're not going to put it into their limited company, but maybe they own it with a partner, a husband, wife, or even someone they're not married to, it might be a brother or sister. But if you own with someone and one of you is a 40% taxpayer and one of you is not, can you declare the rental income on the person with the lower tax rate? So, for example, if it was a husband and wife and one pays 40% tax and one doesn't pay tax, can we give the wife all the rental income, even though you jointly own it?
Bit sexist there, Matthew. Give it to the husband.
It could be the other way around. It's just the way it came out, but yeah.
So the answer to that bluntly is no. So if the title is owned on a 50-50 basis and there are no trust agreements in place, it is a straight 50-50 ownership, then the rental income must be declared on a 50-50 basis. There are various methods, shall we say, that we are able to put in place that can change the structure and the ownership status of a property, so it's not 50-50, so that it's not joint tenants. Effectively, it could be tenants in common with a 60-40 split, a 20-80 split, and whatever else. So we can change the status on there, and that is possible to be done.
But does that have implications on inheritance tax if you're not married?
Yes, so that's exactly it. So you've got a whole scheme of things there. So depending on whether you're married, depends on whether there's a mortgage on there, depends on whether you're the other person is buying you out, all sorts of things. There's lots of other taxes to be considered. So it is a possibility. It can be done. I'm not saying no, it's not possible, but you would have to put something in place for it to be done. You can't just say, okay, I'm a 40% taxpayer now, let's just put all the income on your tax return. Job done. You can't do that.
Okay. Now, we've had a question in from Karen, and Karen has asked about holiday homes. So I don't know if you can answer this one, Chantal, but if you've owned a holiday home for a long time, say 10 years, and you decide to live there as your main residence, I'm guessing you've sold your house, you decide to go and live in your holiday home, and then you sell 5 years after you moved into that one, does that affect the capital gains? Because capital gains is calculated on how much the property has gone up in value over the time that you owned it.
Yes, so it does affect the capital gains. Now, when you say, this is a difficult one, because when somebody says a holiday home, there are two types of holiday homes. And when you say rent in a holiday home, there's two types of rent in a holiday home. You are able to rent a holiday home on a normal, what I call a normal holiday home basis. You might rent it out occasionally just for the summer. And there's another type called a furnished holiday let. So there are specific tax rules for a furnished holiday let, and the tax treatment for a furnished holiday let is slightly different to a tax treatment for a normal rental income on sale, on disposal. So I'm just going to assume, for argument's sake, it's not a furnished holiday let, because they are very, very specific rules, and we're just going to assume for ease of the radio that it's not a furnished holiday let. So in this situation, if you've effectively you've rented it for 5 years, you've lived in it you've rented it for 10 years, you've lived in it for 5 years, you've got a 15-year ownership period now. So you would look at the cost versus the sale over the 15-year period. Today's tax rules, the way they're calculated, means that, unfortunately, we had something called lettings relief, which left us on the 5th of April 2020. So unfortunately, you can't no longer take advantage of that. I'm assuming that you still own the property and didn't sell it before the 5th of April 2020. You would take the gain over that 15-year period. You would apportion that gain over 15 years. So you would divide the gain over 15. So say it's, argument's sake, 15,000. For nice numbers.
So it's £1,000 a year it's gone up in value.
Exactly. So
hopefully it's more.
Hopefully it's a lot more than that, but let's just say £1,000. Well, let's say 10,000 a year then, 150,000 to make the numbers a bit more realistic. So we would take 5/15 of that.
So 1/3.
So 1/3 as being part of a principal private residence relief, because we've lived in it for 5 years. Under the current tax rules, the government gives you an additional 9 months. So we've got 5 years and 9 months that we would then be able to claim.
So 5.75 divided by 15
is our allowance for capital principal private residence relief.
Okay.
The rest of it will be liable to capital gains tax.
And it doesn't matter if the property's gone up more in some years and less in other years. It's averaged over
No, it doesn't matter. And it doesn't matter what the value of the property was when you stopped renting it or when you started. Some people live in it before they rent it. That makes no difference at all. It's basically from start to end, and that's what we need to take a look at, the whole figure.
Divided by the number of years you've lived in it and the number of years you've owned it, all that kind of stuff.
Yeah. And obviously, if you've done improvements in it, you might have put an extension, you might have gone to double glazing, you might have gone from having no central heating to having central heating in there. All those things would be improvements. So they would increase your cost and reduce your profits.
Right.
And they would be, so your profit figure is calculated before we do the apportionment. The business show.
But we're talking all about property today and landlords. So actually, it's a landlord show, isn't it?
Well, it's a property show, isn't it? Really?
Property show.
I like the
property tax show.
Tax show.
We're not bricks and mortar specialists. We can't tell you how to do an extension other than get an architect.
Yeah, exactly.
But always get professional advice appropriate to what you're doing. Now, anyone can call themselves an accountant, can't they?
Yeah, that's a very scary thing, that, isn't it, really? That anybody could set up a business and call themselves an accountant. And I suppose, well, Champs has been in business for over 20 years now.
21 years.
21 years. And we have come across other clients who have come to us and have used other people as their accountants, and they're not actually qualified. And the scariest thing for that is sometimes they don't actually know that their accountant's not qualified.
I'm dealing with someone that's come to us recently who's been dealing with an accountant who says on his website he's an accountant and claims to be a member of a professional organisation. And when I checked with the organisation, they weren't. They weren't.
Oh, you see, that's even worse, isn't it?
Yeah.
So it's always good to make sure that when you do seek professional advice, especially accountants, where you know that it's an industry where somebody can call themselves a qualified accountant even if they're not, it might be worth asking them what accountancy body they belong to and maybe searching them on that accountancy body just to actually see, because there is a members register that you can actually see that they are actually qualified.
And check that they've got professional indemnity cover so that they're insured if they give you the wrong advice.
Yeah.
Interesting.
Scary business, which is why it's always important to use. And also sometimes when you want a reference, some mortgage, when you're going for a mortgage and you need to provide a mortgage certificate signed by an accountant, sometimes that's when clients realise that their accountant actually was never qualified, because they then turn around and say, sorry, I can't provide you with this, because they can't put their initials as belonging to one of the bodies.
Or the mortgage company rejects the
application because it's not qualified by a qualified accountant. So it's always good to plan in advance, I would say.
Absolutely. And when we're talking property tax, normally the numbers can be quite large.
Yes.
So very important.
And if you get it wrong, it can cost you a lot of money.
Okay.
And nobody likes paying too much tax. We've only got like a couple of more bits, have we not, Matthew?
I'm going to ask you a question now which has an implication on inheritance tax. So if someone has a second property and they want to give that to their children, the children might not charge the children. They just want to give the property away to their children, and they currently rent it out. So they're a landlord at the moment, but they think, I've got a property that's surplus to requirements. I don't need the rental income anymore. I'm going to give it to my children for them to live in. Now, is that gift taxable?
So yes, it is. So, and property tax is treated very differently to giving somebody a normal gift of money.
So if I just gave you £10,000...
So if you gave somebody £10,000, you'd have to survive 7 years in order for it not to fall part of your inheritance tax equation. When it comes to property, it's very, very different. We don't have this 7-year rule because it's land. So we need to actually declare that as a sale in our tax returns, because we own an asset that might be worth, say, £300,000, and we're now giving that to our children. Whether our children then rent it on themselves or whether they live in it as their first step on the ladder, then this now means that our value of our estate, of what we were physically worth for inheritance tax reasons, has now gone down. So when your estate of what you're physically worth goes down, you either passed away and therefore you need to pay inheritance tax. You've given it away to somebody as a gift and therefore you need to survive 7 years, or it might fall under one of the inheritance tax gifts exemptions. You've spent it. Effectively, you might have sold something and you've spent the money, effectively, as you might spend rental income, but the asset you've given away is now no longer yours. So that would fall under the capital gains tax bracket, and you would have to pay capital gains tax on that asset, even though you're physically not receiving any money.
So even if your children don't pay you any money, you have to have the house valued to find out its current value?
Yes.
And then you'll pay capital gains tax on the rise in value whilst you owned it?
Yes. So you would look at the same way we calculated previously with Karen's rent a holiday home. It's the same sort of situation. We've got the income less the value with any capital improvements. That's our increase in value. That's what we're paying capital gains tax on. If you're a higher rate taxpayer, which means you pay income tax at over 40%, it's automatically 28%. If you're an 20% taxpayer, we're talking at 18, with potentially some of it at 28 as well, depending on how big the gain is. So we would pay capital gains tax on there. So there's 3 taxes to consider: inheritance tax, capital gains tax, stamp duty, and I had another one in my head there and now it's gone again, but I'll write it down as soon as I remember it. So inheritance tax, it's fallen out of your inheritance tax equation. So when you pass away, you've got no benefits to it. Obviously, you've given it to your children, so now you have no rights over the property. And that's it. So where before you might have rented it, had a rental income, you've got no rights over it anymore. It's not yours anymore. It's your children's to do with as they wish.
Although they have given the house to their children and paid capital gains tax on giving it away, if they died within a year, would it fall back into their estate for inheritance tax?
No, because effectively they've given it away and they've paid the capital gains tax on it.
Okay.
So that's number one. So we've got the capital gains tax and the inheritance tax. Stamp duty. So the children would have no stamp duty to pay on the property.
Assuming they don't own any other properties.
Well, no.
No? Okay.
The children have no stamp duty to pay on the property because they're not paying you for it. Stamp duty...
Even though it's worth, say, $300,000?
Stamp duty is a calculation on consideration. So if you don't actually pay something for the asset that you're receiving, there is no stamp duty payable.
Regardless of whatever the rates are, it's just zero.
Yes,
okay.
Because you're not paying it for it.
Okay.
However, if there is a mortgage on the property, it's a completely different situation. So I'm not going to go into it over the radio because it's very complex and I've only got about 3 minutes left.
Because you're also transferring the mortgage.
And I've only got 3 minutes left.
Okay.
So, but basically, if you've got a mortgage on a property that you want to transfer or gift to somebody else, then that is where you must seek advice before you go and do it, because stamp duty may be payable on that, on part of it. But also, if you're giving it to your children would then need to go out and get a mortgage to pay off your mortgage and effectively pay you, in which case there may be stamp duty there. So I'm just saying,
if they're getting a mortgage to replace your mortgage, that is consideration, isn't it?
It is.
So you have to pay stamp duty on the value of the mortgage, potentially?
Yes. Potentially.
Okay. Sounds quite a complex area.
Yes, it is a very complex area, which is why I say there's lots of taxes to consider in that one, and that's where you need to definitely look at all the different options on there.
Okay. So we've only got a couple of minutes left. Got one question left, something that's come up in the news this week. A lot of people, young people, trying to get on the property ladder, it's a well-known term, have been using the bank of mum and dad. Because nowadays, if you get a 90% mortgage, in fact, recently, because of COVID and other things, banks have only been lending, say, 85% as a maximum. And property values are so high, people are mortgaging as much as they can borrow versus their wages. So to get the deposit then, they might not even be able to borrow 85%. They might only be able to borrow 50, 60, 70%. So to get the extra money, the bank of mum and dad are coming in. So are there any issues with that?
Well, at the moment, you have to consider that depends on what your parents do with the money, with how they give you the bank of mum and dad. So there's various options
because
here.
if they're giving it to you, you've got all those 7-year inheritance tax rules and things, haven't you?
You have. And also you've got property rules to consider with inheritance tax, because you're using the money to purchase property, so it's slightly different there. Example, they might give you a loan.
Okay.
So if they were to give you a loan, and there it's repayable back to mum and dad, your mortgage company might not like that, because effectively there's a second charge over the property.
Effectively, if you borrow 85% and your mum and dad loan you the 15%, actually you've got a 100% loan.
Exactly.
On the property.
And you've got a charge. They might not take a charge over the land registry. They might not take a charge on title.
You mean your parents won't?
Your parents might not take a charge on title, but there is still a charge over the property because there's a second loan over there. Okay. I did read in the news today, this week it was, you bringing up the bank of mum and dad, that there are some mortgage companies, and I can't remember the names of them, but there are some mortgage companies, in actual fact, they want you as the purchaser to prove that the deposit money does not come from the bank of mum and dad. They need you to prove that the deposit money is actually your money and how you've
earned and saved for.
That you've earned and saved for. So it's really important that you've got a really good trail of money. There is an article that I actually wrote in the Caterham Independent newspaper this month, in the August issue.
I have one right in front of me, actually.
So, well, brilliant. Tell me what page it's on.
We always have one in the studio because the Independent do a news show on a Monday morning.
Yeah, so Louise does a show on Mondays. But there is an article... and
I found you. You're on page 5.
I'm on page 5. It's a great... a bit biased here, but I think it's a great article this month. It's actually aimed at savings accounts.
For children?
But it's not only for children. It can be for 15-year-olds, 20-year-olds. It could be for 8-year-olds. It's an understanding of them to learn what I call the 3-tier savings accounts. So you have 3 different tiers of savings accounts. And your tier number 3 is what you're saving for that long-term goal, which could be a deposit for a house. So you could be 15, 18, 16, starting a Saturday job, thinking, okay, in 10 years' time, I need to try and get onto that property ladder. This just shows you what the banks are doing, how important it is to almost have that third savings account, so that when you do go to your deposit, actually, you've got this major history of all your different options. And that's why it's really important. So if you haven't read the article, you can get a copy of the Caterham Independent, and Chantal will be putting it on my Instagram account. But if you've got any questions on the 3-tier savings account,
and if you haven't got a paper copy and you haven't picked one up, they are available in some of the local shops. I'm pretty sure the Independent is available online. Just go to caterhamindependent.com and you'll find a copy of the newspaper online.
Yeah. Or if you need a copy of the newspaper, I'm sure if you email in the newspaper themselves, then they will be able to tell you where you can pick it up from.
Yeah, absolutely.
Come to the end of our show, Matthew.
I think we have come to the end of the show. That's all my questions for you. So thank you, Chantal. That was some very detailed tax knowledge, but it just shows how important it is to get advice, because it is a very complex area.
Yeah.
And it's a high-value area as well.
It's a very high-value area, and I think it's an area that a lot of people have maybe dipped into with a property. They might have fallen into it by inheriting a property. They might have inherited a holiday home, or they might have purchased that holiday, or they might end up being two separate individuals who then buy a property together. And then one of them rents out the other one, and it's all different situations. So hopefully that has answered all your questions. If you want to listen again to the show, or if you missed anything, it will be available to listen again on our Mixcloud feature, which is mixcloud.com/Chantal Baker. And in actual fact, Champ Consultants also have their own podcast, and this will be uploaded to their podcast, which will be
on Spotify.
It was on Spotify and on Google, and I believe this one will be on Apple as well. Apple iPods.
We're really going for it. But you can just search on Spotify for, say, Champ Consultants.
Yeah, if you search on Spotify for Champ Consultants, you will be able to find it there.
Brilliant.
And that's it. I do
believe
we've
run out of time.
We have. So Matthew and I will see you next week, and we hope you enjoy and have a good weekend.
Thank you very
enjoy
much for
the
listening.
sunshine.